Hello, everyone. Welcome back. And we are sitting right here in the middle of January of 2024. So, Happy New Year to everybody. I hope everyone had a great holiday, Merry Christmas. And we are now looking at 2023, a year in review for the Zacks Earning Certain family of portfolios. My name is Mayur Thaker. I am an equity strategist here at Zacks Professional Services, as well as the co-portfolio manager of the Zacks Earning Certain family of portfolios. That is, a collection of three portfolios, of which the flagship portfolio, which is a portfolio of 75 companies that we manage and maintain here at Zacks, which will be the primary topic of today's presentation. So we're going to take a look at how 2023 went in terms of total return versus the S&P 500, as well as some of the key contributors to those returns, and a look at a little bit about what might be causing that return and how the outlook looks for the future. So let's get started on that. Here we have a chart or just a simple table. This was obviously a very difficult year for the Earning Certain portfolio. That is the flagship 75 company portfolio. We had a return of 10.6% for the year of 2023 versus a whopping 26.25% for the S&P 500. So that is a underperformance by over 15% for the year. So that was a pretty bad year in terms of relative performance, probably one of our worst, in fact, since we started managing this portfolio way back in 2012. So this was probably the worst relative performance year we've ever had since we launched this portfolio over 10 years ago. And what's important to understand is a little bit about why that has happened. So let's take a look a little bit and dig a little bit deeper as to why that might have happened. Here is a table of the returns for the year. You can see a chart on the upper right corner. The light blue line represents the S&P 500 ETF. That's the IVV ETF, versus us in the Earning Certain portfolio right here, which has been obviously a deep laggard for the year. We continue to do exactly in line with what we would expect to do in terms of the beta of the portfolio. You can see that the beta of the portfolio for 2023 remained at 0.73. That's typically where it usually lies. So the Earning Certain portfolio typically does much better on a relative basis versus the S&P during bear market periods. So especially during big drawdowns like we saw in 2022. The portfolio really does well in separating from the pack, when it comes to big drawdowns. But when it comes to big bull market years, we typically lag. However, historically, we've had strong bull market years, in 2013, as well as in 2017, and several other, very good years after that. And the Earning Certain never trailed by anywhere close to how much we trailed this year. We were always within just a couple of percentage points, in those strong, bull market years like 2013 and 2017. So what happened this year? 2023 was primarily a reversal year for the S&P because it suffered an 18% drop in 2022. If you recall, ending 2022, the markets were down quite substantially. And that was when recession became the consensus at the time. So recession was starting to get priced in. A good portion of it was priced in, at least in terms of a mild recession. However, that anticipated recession never actually showed up. And, I've been talking about recession for quite a while now, for, over a year at this point. I still continue to believe that is the base case, going forward. So I've, clearly been, wrong so far on that call. And so because the recession that many had feared in late 2022 never showed up especially after the Fed and the Treasury intervened to quash the regional bank crisis that started in March. If you recall, we had big failures in Silicon Valley Bank, as well as other regional banks, and the Fed and Treasury did a very quick job at stemming that crisis and providing bank term liquidity funding for banks to stabilize their liquidity levels in the wake of very large unrealized losses on their held to maturity securities. That was a big story in the first quarter of last year. And so because the Fed and the Treasury took swift action to stem what could have been a contagion, that anticipated recession never showed up. And so because that was the base case ending 2022, and because that recession never actually happened, we had a significant reversal from that drop in 2022. So remember, that was the base case. Ending 2022, the base case was recession. That recession never happened. And so much of those losses of 2022 were then reversed in 2023. And then what happened in Q4 of 2023 was continued moderation in the rate of inflation. Ever since we got the October CPI, which came in well below expectations, that caused the 10-year yield to really drop like a rock after it soared in September and much of October. And so as the 10-year yield eased after it soared to over 5%, it dropped 100 basis points in the preceding 2 months. That significant easing of inflation and easing of treasury yields together ignited a massive rally, primarily in high duration equities. These were the companies that had fallen the worst in 2022. So because we had two big negatives removed, one, recession, and two, high interest rates, we had a rally in high duration equities, and that primarily benefits companies in the S&P 500, and it doesn't really benefit companies in the ECP portfolio, because companies that we own in the ECP are not high duration, high beta companies. They are low beta, low to mid duration equities, especially defensive equities that especially do well in recessionary environments. And so because that recessionary environment really dissipated as the year went on, we had a rally in areas of the market where we don't have a lot of exposure in the ECP portfolio. So again, remember, the ECP portfolio is comprised of high quality, low beta, defensive businesses. And it was precisely that area of the market that never actually was the primary beneficiary of easing of interest rates and a recession that never actually showed up. So that scenario was the perfect storm, the Goldilocks scenario that primarily and almost exclusively benefits high duration, high beta equities, which is exactly the area of the market that we don't have any or much exposure to. So that was the main reason, I believe, why we had such a significant underperformance last year. Now, let's look at performance attribution. This is something that I think will add a lot of color to the underperformance that we had. So we're going to look at, what explains returns, right? Returns can be explained in basically two ways: earnings growth and PE multiples on those earnings growth. So primarily the delta in the PE multiple on earnings. So here we have earnings growth, and you can see that 2023, despite the fact that we didn't get a recession, we actually had no earnings growth for the S&P 500. Here we see in that bottom chart the composite for the SPY ETF in terms of earnings per share growth during the year of 2023 was actually negative 1.1%. So earnings actually declined year over year during the course of 2023, whereas for the earnings certain for the earnings certain portfolio, earnings grew 6%. So we actually did significantly better than the S&P in terms of earnings growth in 2023. So despite the fact that we had significant underperformance, in 2023, we did significantly better, fundamentally speaking, in terms of earnings per share growth versus the S&P 500. So that means that the explanation behind the significant outperformance of the S&P has to be in the other, area of, that explains returns, which is PE multiple expansion. So here we have that here, and check out that spread. The earnings certain portfolio only received a 2% PE multiple expansion during the year, which is basically it's negligible. Whereas the S&P had a 20% expansion in the PE multiple. We're using trailing 12-month PEs, earnings, by the way. And so from the beginning of the year to the end of the year, the PE multiple on trailing 4-quarter earnings grew by 20% versus just 2% for the earnings certain portfolio. So almost all of the gains, in fact, substantially all of the gains that we saw for 2023. So these gains right here, 26% versus 10%. The vast majority of those returns is attributable to PE multiple expansion, not earnings growth, as we see here in these two charts. So this tells you a lot about where these returns are coming from. When PE multiples expand, that typically only happens for one or two reasons. One is growth expectations, and number two is a declining cost of capital. Those are the only two reasons that can explain PE multiple expansion. And we got kind of both of those things happening simultaneously. One, we have earnings expectations for 2024 very, very robust. As of right now, analysts expect 12% earnings growth in 2024. Now, if you are following some of my other macro videos, I think that number is substantially overstated. I think that we're going to get significant earnings estimate revisions to the downside. But as of right now, at least, analysts are sticking with roughly 12% earnings growth for next year. And so this PE multiple expansion is in part due to optimism for earnings growth to resume in 2024. Because remember, as we saw in this chart, earnings contracted in 2023. So as of right now, there's a lot of optimism that earnings growth is going to return in 2024. I believe that optimism is unfounded due to leading economic indicators such as ISM manufacturing and credit growth. I think both of those are in contraction, which does not bode well for earnings in 2024. But as of right now, this PE multiple expansion is due to optimism for 2024 earnings growth. At the same time, we saw the 10-year Treasury yield drop from 5% to about 4%, primarily due to an easing of the rate of inflation, right, as we saw, which is increasing bets that we are going to get a soft landing, basically a scenario in which inflation successfully returns back to the Fed's target of 2% while avoiding recession. So that is currently the bet that's being made into the market today. And again, I think that's a very dangerous bet because that is now the base case. If you were to take a look at the S&P 500 multiple on forward earnings, we're approaching almost 20 times. That is a very, very strong bet that a soft landing and a swift earnings recovery is now priced into the market today. If we don't get that, then that puts this rally at risk significantly. So again, the earnings certain portfolio did exactly what it's supposed to do, which is deliver yet another year of stable, predictable earnings growth, which came in at about 6% last year. So the earnings certain portfolio delivered better earnings growth, but the S&P 500 enjoyed significantly higher PE multiple expansion throughout 2023. That right there is the explanation as to why the S&P did so much better than the ECP portfolio. PE multiple expansion, really no other explanation behind it. And the PE multiple expansion, in turn, is being driven by optimism for 2024 in terms of earnings, as well as an easing of interest rates, which is kind of serving a dual boost to high risk, high duration equities. Possible explanations, again, AI excitement, especially in NVIDIA. You see earnings estimates continue to rise for NVIDIA, so that's a big standout. Whereas the S&P 500 as an aggregate did very poorly in terms of earnings growth last year, NVIDIA continues to see upward revisions in estimates. Again, rising expectations of a soft landing that primarily benefits high beta, high duration risk assets. Again, exactly the area of the market that we don't have much exposure to. That is the area that's getting the best lift from, rising expectations of a soft landing. Also, another thing that's very, very cautionary, which is that there is now extreme concentration risk in the S&P. The top 7 market cap companies in the S&P, now dominate 30% of the index. That is an all-time high by far. And so because the returns have been primarily concentrated in those mega cap tech companies, that's another reason why the S&P had such a strong return last year. We have high concentration, and the companies that are, that the index is concentrated in happen to be the ones that were the best performing assets for the year. So it was really a perfect storm for the S&P 500 last year. High concentration in exactly the companies that did the best, and rising bets of a soft landing, which again is the reason why high beta, high duration assets did so well in the first place. So again, this is almost like threading the needle here, where the S&P 500 is positioned exactly in the right area in which macro trends benefited the most. So I don't think that is going to be repeatable very often. And so we will see how 2024 ends up. But as of right now, the market is, pricing in kind of a very dangerous combination of a swift earnings recovery and no recession in sight. And I think that risk, expectation is at risk. So the top performers, at least, let's take some good news in our portfolio. So these are the top 3 performers for us in 2023, Intuit, Costco, and Grainger. Intuit, one of the reasons why that did so well is, this is one of the few companies in the ECP portfolio that actually do fall into that big tech category. Intuit is, really a tech company at its core. Intuit is better known for, their ownership of TurboTax, which, an increasing number of people rely on every single year to prepare their tax returns. Very, very easy to use, very simple. And so Intuit, had a very strong bounce back year, primarily because they were caught up in the NASDAQ bear market of 2022. So Intuit is one of the rare companies that we own in the ECP that actually did benefit from the macro developments of last year. And so that's why we saw a blazing hot 61% return last year. Costco, again, is another, time-tested winner. We've owned this, company for many years now in the ECP portfolio. It continues to compound almost every year since we've owned it. That was up a whopping 49%. Again, a big reversal from what we saw last year, ending 2022. Grainger is another company that benefited quite well because, again, Grainger is a logistics company at heart. They provide MRO services, for enterprises. And so, because recession never really took hold last year, they were a primary beneficiary, a major beneficiary of that reversal theme that I talked about. So the big story of last year was a reversal. Recession was the base case entering 2023. That was implied into valuations entering 2023. And because we never got that, and in fact we got a easing of inflation and easing of interest rates, that was a great unwinding of the recession trade. And that really benefited these three companies significantly in 2023. Now, the bottom performers in 2023, again, are all three in the consumer staples area, which again are exactly the areas that don't do well when bets of recession, recede. And so Hormel, Hershey's, and General Mills, these are highly defensive companies. They do well in basically all environments in terms of earnings growth. But because the recession trade faded as the year went on, these companies, subsequently got, backed out, in terms of their strong 2022 performances. So it was the exact opposite of, the NASDAQ and other high beta equities. However, we continue to stick by that. Hershey's is just a phenomenal compounder. Let me just dive into Excel World real quick to show you exactly what we see in a Hershey's, for example. The question a lot of people might have is, well, why Hershey's, right? It's such an old company. All they do is make chocolate. But you would be surprised as to exactly what they are able to achieve. Here is the spreadsheet that I like to use quite often in determining companies that we own in the ECP portfolio. Look at this incredibly consistent return on invested capital. This tells you the returns that the company generates per dollar of investment that they make. This has been remarkable at well over 20%. This is a very, very profitable business. At the same time, they continue to compound those earnings because you can see that the denominator continues to rise. What this means is that the company continues to retain cash flow and reinvest it back into the business. So this is remarkable for such an old company like Hershey's, that management continues to see investment opportunities, and therefore they continue to invest in factories and equipment and in expanding manufacturing capabilities, expanding in new parts of the globe. So they continue to reinvest, as you can see here, which is why invested capital, which basically measures the size of the balance sheet, continues to rise almost every single quarter. As you can see down here at the bottom, free cash flow continues to compound as a result of that. Operating cash flow, again, continues to compound very, very steadily. And here you can see free cash flow conversion. Again, a phenomenal number. It has come down a little bit, but again, still well above 80%, which is the threshold I like to look for. And it stays above, or at least around 100% most of the time over the long haul. So again, this, there's some cyclicality or some volatility is to be expected. But the long-term average, as you can see, is right around 100%. So that gives you a very, very high level of confidence in the quality of these earnings. Terrific compounder. So despite the fact that it had a rough year last year, we continue to own it because it is a long-term winner in our eyes. And the same thing goes with all three of these companies here, Hormel and General Mills. Very, very solid compounders. So any volatility in the share price is mostly because of PE multiple swings, but fundamentally they continue to execute, and to generate high growth at high linearity, at high ROIC, and with high free cash flow conversion. That is the 4 pillars of quality that we use to determine and build this portfolio. So again, the ECP portfolios are optimized for quality as per that big 4 metrics for quality: growth, linearity, ROIC, and free cash flow conversion. We believe that a long-term focus on these 4 principles of equity investing will add significant value to shareholders over the long run. So again, as long as you stick with companies that continue to show high growth in earnings per share, high linearity in earnings per share growth, strong capital allocation and reinvestment, as we just saw, and they have to be able to convert earnings into free cash flow at a high rate, which tells you the quality of earnings that they're reporting. So over time, we expect, because of these 4 principles that we adhere to, we expect that the earnings certain family of portfolios will outperform their benchmarks on both a risk-adjusted and absolute basis. So obviously last year was a disappointment on that front, but we continue to believe that these are principles that are not negated in any over a long period of time. So despite the fact that we had a tough time last year, our companies continue to build fundamentally. And this is because our companies are recession resistant. They're high quality, durable businesses with exceptional track records of generating high ROIC capital allocation. So as long as our companies continue to execute on these big 4 metrics of quality, we believe, and we continue to believe, that our strategy will outperform over a complete market cycle. So here is a depiction of growth and linearity, the first 2 principles that we adhere to. As you can see here, the growth of earnings has been about 12% long-term, going back 25 years. And you can see how linear that earnings has been. So even during recessions, you don't see a lot of volatility in earnings. That contrasts quite highly with the S&P 500. And so we continue to be very, very pleased with the progress in earnings per share growth and linearity together. And then here you can see the third principle, which is return on invested capital. This is, again, very, very strong. This shows you, how, much profit companies in our portfolio are generating per dollar of investment. So again, this tells you capital efficiency. Companies that have high ROIC tend to generate excess free cash flow. And so when you generate excess free cash flow, that goes into things like, share buybacks and dividends, which adds significant value to shareholders over time. So as you can see there, free cash flow continues to, come in quite well. Back to trend here, we saw a little bit of a, downturn in 2022, but we saw a very strong snapback in 2023 with regards to free cash flow growth. So again, free cash flow per share growth, in my view, is the most powerful force in generating shareholder returns. And so that is exactly what we optimize the portfolio to do. So again, despite the fact that we had a tough year last year, fundamentally these companies continue to execute just as they always have done, for decades now. Here is an important piece of context that we really should, consider, and that is that despite the fact that we underperformed by over 15% last year, look at the returns over a 2-year period. So if you were to add both 2022 and 2023, our returns are still lagging the market, but by nowhere close to what we saw last year. So the 2-year return for the portfolio is just under 1%. It's about 0.8%, whereas the S&P is up about 3.5%. So it's still an outperformance for the S&P, still not as good as what we would like it to be, but it's nowhere nearly as bad as what last year's numbers told us. And the reason for that is because we did much better than the S&P did in 2022 during that, big bear market year. So again, the S&P dropped about 18% in 2022, whereas the ECP portfolio was only down 8% that year. So we had a pretty good start to the year, but then again, because we had such a risk-on rally for much of 2023, but especially in that last, quarter of 2023, when risk assets really ignited, mostly due to PE multiple expansion, I might add, that really benefited the S&P a lot more than it did our portfolio, because again, our portfolio is really not allocated in that sector of the market that benefits from, a receding recession expectation. So again, looking at a complete market cycle from 12-2021 to 12-2023, our portfolio did show similar returns, but again with significantly less risk. That's a very, very key point to make there. And here again, long term, even though we had a tough year last year, but long term we continue to show significant value. You can see that this is the performance going back to 2008. I will, make that, disclaimer that, we only started managing this portfolio. This portfolio was incepted in 2012, I should say. And so therefore, the returns that you see prior to 2012 are back tested based on a static portfolio. So again, that's, primarily for illustrative purposes only, just to give you an idea of what the returns might have looked like, but they are not real returns. However, all the returns post 2012 are actual returns, based on the actual numbers that we saw. But you can see that we have, generated substantial value over the long haul. So again, over a complete market cycle between, a bear market to bull market transition, we believe that we will continue to add significant value. You can see that we underperformed during up markets, but more than make up for it during down markets, as you can see here. A 10.25% outperformance during down markets, a 7.75% underperformance during up markets. And so therefore we have an overall excess return of over 200 basis points if you were to combine all of that together. So again, we expect over a complete market cycle to deliver better returns on both an absolute basis and on a risk-adjusted basis. As you can see here, we have a lower beta versus the S&P 500, lower standard deviation of returns for the S&P versus the S&P 500, and slightly better absolute returns versus the S&P 500. Again, this is over the long haul, over multiple cycles. So we trust that will continue going into the future as well, as long as we continue to focus on the areas or factors that add the most shareholder value in the long term. And that is, again, going back to these 4 principles here that we believe are very, very, very important in sticking to growth, linearity, ROIC, free cash flow conversion. If we stick to that and own, leaders in their respective fields, own companies that are protected by strong moats in the form of network effects, in the form of switching costs, in the form of, being the price leader, in the form of economies of scale, barriers to entry, things like that. These are all these are all factors that define the companies that we own in our portfolio. So again, my ideal capital allocation for 2024, stick with the earnings certain portfolio, but also you can, own, short-term treasuries, which currently pay 5%. I think that is going to serve as a substantial, area of value, especially as the S&P 500 now trades at almost 20 times earnings. And those earnings, I believe, are highly vulnerable. So I will change my views as, the data changes. But as of right now, the leading indicators of earnings to me is saying that earnings expectations will be marked down for the S&P 500. And so in that scenario, the earnings certain portfolio will shine on a relative basis. So stick with treasuries that currently pay 5%, stick with high quality investment grade short-term bonds, and then get the earnings certain portfolio. You can stick to the areas that are the lowest beta, companies that have dividend growth or share buybacks, and companies with a low Shiller PE, basically positioned for a low growth environment with a combination of recession resistant growth and income, which are the treasuries. So again, these are the types of companies that we own in the portfolio. Again, high quality, deep moated businesses that are durable and recession resistant. They've proven the ability to resist recession, and that's the types of companies that we are continuing to stick by. And here you can see a depiction, an illustration of just how stable these companies are in terms of earnings per share growth. So I hope you found this helpful. Again, I'd love to hear from you if you have any questions, or if you would like a copy of the slide deck. Please do reach out to us at strategycall@zackspro.com, or give us a call at 1-866-794-6065. Again, hope to see you again in a future webinar here, and talk to you soon. Take care, everyone. Bye-bye.